In this session we're going to look at IAS 16, which covers property, plant and equipment. So we're going to look at what property, plant and equipment is. We'll look at when it should be recognised or included in a set of accounts as such. We'll look at how it should be valued at the start of ownership, and then how it should be dealt with afterwards. So we'll consider depreciation and revaluations of property, plant and equipment. So first of all, we need to define what property, plant and equipment is. Well, it has three characteristics. First of all, it should be tangible, so it's got a physical presence. Secondly, it should be held by use by the company or business, either in the supply of goods or services, for instance a piece of machinery used in manufacturing an item, or it should be held for rental to others, or it should be held for administrative purposes. Lastly, we're talking about a long-term asset, so it's not something that is just going to be purchased and used up immediately. So we would expect it to be used for more than one accounting period. We have a variety of different examples, and this is not a comprehensive list, but property, plant and equipment would include things such as land, buildings, plant, machinery, vehicles, computer equipment, furniture, fixtures and fittings, etc. So our next question is, when do we recognise property, plant and equipment in the accounts? And here a couple of tests need to be met before we can do that. First of all, any benefits associated with the property, plant and equipment are going to go to the company. So for example, if you own a machine, you can use that to the company's advantage in manufacturing the products. Or you might own a building and you're going to benefit from that by renting it out. So the benefits will go to the company. Secondly, we must be able to measure the cost of the item reliably. If we can't do that, then we can't recognise that we have property, plant or equipment. So how should we value property, plant and equipment at the start? Well, it should be recorded at its cost. Now when we're thinking about our cost, we need to be able to identify how to calculate that cost. And we're going to include all costs of bringing the asset into working condition. So that would include things such as the purchase price or any import duties payable on it. We'd include the costs of site preparation or delivery costs to the site. We'd include installation, assembly and testing costs, as well as any professional fees such as solicitors' fees on the acquisition of a building. We would also include any estimated costs of dismantling or removing the asset if we were likely to incur such costs at the end of the asset's life. We would, however, exclude certain types of costs. We wouldn't include any admin or general overheads, nor would we include the costs of opening a new facility or introducing a new product or service, or the costs of conducting business in a new location or with a new class of customers. So we would exclude any costs of product launches, for example. Now it's often the case that after we acquire an asset, we then incur additional costs. And the way that we treat these additional costs depend on their nature. So any expenditure that simply maintains the condition of the property, plant and equipment should be treated as an expense. And this would include things such as repairs, maintenance costs and servicing costs. Where the expenditure actually improves the property, plant and equipment, well, in that instance, the amount spent should be added to the cost of the property, plant and equipment. So for example, if we built an extension onto a factory, the cost of that extension would then be capitalised and treated as an asset. Another example might be where we upgrade some machinery that improves its performance beyond its original specifications. So we're not just maintaining the asset, we're improving it, and that cost would be capitalised and added to the cost of the property, plant and equipment. Now, after we've recorded property, plant and equipment at its cost, we can now start thinking about what happens next. Well, property, plant and equipment should be depreciated over its useful life, and then it's going to be shown in the statement of financial position at its carrying value. The one exception to this would be freehold land, where we assume that that has an infinite useful life, so freehold land is not depreciated. But property, plant and equipment, its cost less its residual value, that's the amount that we would expect to charge through the income statement over the asset's useful life. The amount that gets charged each year will depend upon the method of depreciation that we choose to use. The two most common methods in the UK are the straight line method, where the depreciation charge is set at a constant rate each period, or the reducing balance method, where the depreciation charge is based on a fixed percentage of the carrying value. And so with the reducing balance method, we see a high charge at the start of the asset's life, and which then gradually falls each period until the asset is either scrapped or disposed of. Just to remind you about these terms useful life and residual value, the useful life is the length of time we expect to use that asset in our business, and when we estimate it, we're going to consider things such as expected usage, wear and tear, obsolescence of the item, and also whether there are any legal or regulatory limits as to an asset's use. The useful life of any asset should be reviewed each year, and where there is a change from our initial estimate, we might have to recalculate the depreciation based on our new estimated remaining life. The residual value, of course, this is the amount we expect to gain from the asset at the end of its useful life, so the amount we think we could sell it for when we're finished with it. Again, residual value should be reviewed each year, and if it changes by a significant amount, we should recalculate the depreciation charges that we're going to set against that asset. Of course, at the end of an asset's life, or indeed at any point during its life, we might decide to dispose of the property, plant and equipment. So either sell it or scrap it. At this point, we're going to compare two figures: the item's carrying value at the date of disposal with the disposal proceeds, how much we get for that asset. Where our disposal proceeds are greater than the carrying amount, we will have made a profit on the disposal. Whereas where the disposal proceeds are less than the carrying amount, we'll have made a loss. Now, so far we've been thinking about our property, plant and equipment in terms of cost and depreciation. And that's the more standard way of treating property, plant and equipment. But IAS 16 allows two treatments. the cost model, which is what we've been looking at, and also the revaluation model, where assets are valued not at their cost less depreciation, but at their fair value less any depreciation. The cost model is by far the most common method, but the revaluation model is often used by companies where they have a particular asset whose value is significantly higher than its cost less depreciation. The most common type of asset where this occurs are land and buildings, as they do tend to go up in value over time rather than fall, which is the case with most machines and vehicles, say. Now, if we are going to revalue an asset, there are a couple of conditions that we have to meet. First of all, if you are going to revalue an asset, you're going to have to undertake regular revaluations from then on that asset. So it's not the case that you can do it once and then leave it forever. Also, assets within the same class have to be treated in the same way. So let's say that you own one building that you wish to revalue. If you own any other similar buildings, you're going to have to revalue them as well, because all assets in the same class would then have to be revalued, and then regular revaluations of each of those assets would have to be undertaken from then on. Now, so far we've been talking about fair value. Fair value is the amount for which an asset could be exchanged for between knowledgeable, willing parties in an arm's length transaction. And in the vast majority of cases, it's going to be the market value. For some assets, however, there is no market value, so other methods might have to be used in that instance. So let's have a look now at the revaluation process itself. And there are 3 steps that you would have to take when revaluing an asset. The first is that the asset's cost should be restated at its fair value. Then we're going to remove any accumulated depreciation that has already been charged against the revalued asset. And finally, any increase in the carrying value will be sent to a revaluation reserve. If it's the case that we've got a decrease in valuation, then that is normally treated as an expense. The revaluation reserve itself is a part of equity, and it's shown in that section of the statement of financial position. So let's have an illustration of this revaluation process. Let's say that we have a building that's currently shown in the accounts at cost less accumulated depreciation. So we have cost of 200,000, accumulated depreciation of 50,000, so it's currently included in our statement of financial position at a carrying value of £150,000. The directors then decide to revalue that building to its fair value of 800,000. So first of all, we're going to restate the cost to its fair value. So we're going to increase or debit cost by 600,000. That's the difference between our initial cost of 200,000 and the fair value of 800,000. Next, we'll get rid of the accumulated depreciation. So I'm going to decrease or debit accumulated depreciation with £50,000. Lastly, I will send the increase in carrying value to the revaluation reserve. Well, we have an increase in the carrying value of 800,000 less 150,000, which is 650,000. So we're going to increase or credit the revaluation reserve by 650,000. So what do we do once we've revalued an item of property, plant and equipment? Well, we then have to start the process of depreciating that revalued asset. So it's going to be depreciated over the asset's remaining useful life. So this is simply the normal process we'd go through. I suppose the one difference is that when we calculate the depreciation charges, we don't use the original cost in our calculations, we use the revalued amount or fair value. The depreciation is charged then in full as an expense in the income statement. Although companies may then transfer some of that charge and set it against the revaluation reserve for that asset. And that way, if the asset is then held until it's completely useless and worthless, then the revaluation reserve against that asset would have been reduced to zero. Where it's the case that we then dispose of a revalued asset, we calculate the gain or the loss as normal. So we calculate it as the disposal proceeds less the carrying amount. Gains and losses are reported in the comprehensive income statement as they would normally. But the one difference is that any amount in the revaluation reserve that relates to the asset that's been disposed of is then transferred to retained earnings. And that way, when a revalued asset is disposed of, any revaluation reserve relating to that asset is eliminated at the same time.